So with all of this record issuance, how is this impacting the markets? And there's a lot of supply. Does that mean it's too much supply? But you're saying they're oversubscribed. So it must be
Deals are
strong
oversubscribed.
demand.
There's still a lot of cash on the sidelines, and when markets get nervous, they look towards safety. Generally, treasuries act as a safe haven, but I think concerns about inflation is what's been driving interest rates up from where they got lows at the end of February to where they are today. But that also boosts all-in corporate yield, and then adding a spread for corporate bonds above that of treasuries. And again, yields are higher on the year now, despite spreads being unchanged. It just makes it more attractive for investors to lock in, these 5+% yields on investment grade credit bonds. So supply is being absorbed, and it's not actually having any widening effect on the market. Like there were concerns, are can the market absorb it? Very, very easily.
Let's just take a big overview here. Investment grade credit had a terrific year in 2025. The performance was very, very strong. What are you looking at for 2026? Do you think this is going to continue, or are you a little cautious? Where do you stand?
Well, I was hoping at the beginning of the year that we would see similar performance in 2026, in the upper single digits, that 7 to 8% range where we came in last year. We thought it would be more of a carry trade, coupon clipping with yields around 5%, then a little bit extra from a few Fed cuts if we got those later in the year. I think the conflict in Iran has changed the picture somewhat. Returns in the first quarter for corporates were very, very modestly negative, about 0.5%. Today, we're looking at about flat returns year to date. So we kind of lost that first quarter. So if we were to get coupon clipping, for the balance of the year, we'd see returns maybe around 4%, which is still okay. Now, it also depends on what the Fed does and what are the ramifications. It's just too soon to tell. What does this mean for the economy today? With the tentative fragile ceasefire that is in place, markets are rallying strong, both equity and credits as well, so that spreads are almost unchanged on the year despite all of this volatility. But we don't know what the longer term ramifications are. Even though oil prices have come down now to the mid 90s, they are still well elevated from where they were earlier in the year.
Mhm.
What does this mean for inflation? What does this mean for GDP? We expect this earnings quarter to be very strong. There's been a lot of, raising guidance into this. So if that performs well, we see maybe less of an impetus for as many Fed cuts on the table, or maybe those get pushed back to next year. So we may not get that boost from an underlying interest rate rally that we were hoping for. But we are still constructive on credit, and we still think returns around that 4 to 5% area are attractive. Bonds should perform as bonds will. At these higher underlying yields, there's much more of a cushion in terms of allowing for these little hiccups where you see interest rates sell off and bond prices have a quarter of modestly negative returns, but we expect that to reverse itself.